Welcome to The Journey, a patchwork of care presented by the Senior Journey Alliance. We have a lovely evening prepared for you. A few housekeeping things before we begin. Right outside the door, I'm saying most of you have partaken, but just so you know, a lovely spread of food. If you want any more, please feel free. If you need to use the restroom, out this door past the food, a little bit further straight to your right is going to be the restrooms. Lastly, we will have a Q&A at the end of the presentation. On the back of one of the pieces of paper in front of you, there is a section to write down your questions so you don't forget when it is time to ask them. I know I would. So we will begin. I hope you have a lovely evening, and we will start with Mr. Christopher Carrillo.
All right. There we go. Good evening, everybody. My name is Christopher Carrillo, and on behalf of our entire team, I would like to thank all of you for coming out to our seminar. We're very happy to have you here. Welcome. To begin, I wanted to take a moment and share with everyone a little bit about the name for our seminar. Uh-oh. Looks like I went too far. There we go. As you can see, the name of our seminar is called The Journey, a Patchwork of Care. And a little bit about that. So if you think about all of the stages that we go through as we navigate this journey that we call life, there are many different ways in which we access our nation's healthcare system. You have obviously health insurance, then there's long-term care, Medicare, Medicaid, savings. So there are an awful lot of puzzle pieces that can come into play as we navigate the various phases of life. And of course, one of the things I've learned in my career as a financial advisor is that there can be a lot of confusion in our society about what covers what. And so one of the things I like to do as an advisor is help all of my clients understand how all of the puzzle pieces fit together. And then, of course, you have receiving care. And when you think about how we receive care, again, you have many different puzzle pieces. You have hospital care, your primary physician, in-home care, assisted living, nursing home care, then, of course, all of the care coordination services that help you figure out what's going to be most appropriate for you. So it really is a patchwork of care as we navigate this journey that we call life. So, as I mentioned, I work as a financial advisor. I got started in my profession in 2012. And I will tell you that the way that we do long-term care planning, which is what I will be speaking about this evening, it's evolved quite a bit. The way that we did long-term care planning in 2012 is very different than how we do planning now. So the first question is, why is it important to plan? Well, the first answer to that question is options. It's very important to have a plan in place because if you don't have a plan in place, you severely limit your options later in life. So putting a plan together now will give you options later. Now, a number of years ago, they did a study and they asked seniors who had made the decision to purchase long-term care why they made the decision to do so. The vast majority of seniors that participated in the study said that they made the decision to purchase long-term care because they didn't want to be a burden to their children. And if you think about that from the perspective of their adult children, this is not necessarily a selfish thing. It's actually very pragmatic. If you think about it, many adult children have a very sincere desire to help mom and dad when mom and dad get a little older and require some additional help. But life happens, and sometimes circumstances mean that it's a little bit more challenging for adult children to help. And so, therefore, even though many adult children feel it's very important to help, sometimes there are constraints, time constraints and financial constraints being the two most prominent. So therefore, having a plan in place is very helpful for families. Then, of course, there's inflation. As we all know, in recent years, our society has had to contend with an awful lot of inflation. Long-term care is by no means an exception. In fact, historically speaking, the inflation rate for long-term care has been higher than the inflation rate for the overall economy. And so therefore, having a plan in place will also help you mitigate inflationary pressures that affect long-term care. And then last but not least, it's very important to preserve your nest egg. I can't tell you how many times I have meetings with people, and whenever I bring up long-term care, they get very adamant about the idea of self-funding their care. And of course, the reason that they're so adamant about that is they look at their retirement nest egg, they look at all of the assets that they've accumulated across the course of their career, and they figure, that number is pretty healthy. I think I'll be fine. I'll be able to cover any expenses that may come up later in life. But then we start looking at the costs associated with long-term care, and that's when we realize how quickly the costs that we have now can erode one's nest egg. So, is this long-term care planning that we do? It really does go a long way towards helping people preserve their retirement nest egg. And if we're working with a married couple, it's even more important because if one spouse gets sick first, we have to make sure that there's something there for the surviving spouse later on. So, very important considerations. This is where we're going to spend the vast majority of our time together. Solutions. So, the evolution of long-term care planning. Like I said earlier, the way that we did planning in 2012, when I first got started working as a financial advisor, is very different than how we do planning now. To give you a little background, when the insurance companies invented long-term care insurance years ago, they didn't really have a very good idea of how to properly price the products. And they just didn't have any experience with that. There was no data to go off of. Of course, when many of those early policy owners started to go on claim, then all of a sudden the insurance companies that were in that long-term care space at that time, they realized, uh-oh, we made a bit of a mistake. And so they realized not only were they not making money on that particular line of business, they were actually losing a lot of money. And so as a result of that, many of the insurance companies that were in the long-term care space on day one got out. The companies that remained in the long-term care space, those were the companies where we really started to see a pretty substantial track record of rate increases. And so over the years, the general public got kind of turned off to the traditional, or what we refer to as standalone, long-term care insurance policies. And there's really three reasons why. The first reason is the history of rate increases. Obviously, no insurance company was immune to that. Every insurance company has had rate increases. The second reason is in certain circumstances, the insurance companies would say to someone, okay, we won't raise your rates this year, but instead what we're going to have to do is we're going to have to reduce the benefits that are held within your long-term care benefits pool. And of course, policy owners didn't like that for obvious reasons. And if you think about it, it was really a horrible situation for many seniors because you're putting them in a position to make some pretty tough decisions when it comes to their policy when they're on a fixed income. And with those raising rates, it really forced a lot of seniors to ask some pretty tough questions. For example, do I keep this policy? Do I cancel this policy? It was really a horrible situation a lot of people found themselves in. But the third reason people got turned off to the traditional long-term care insurance policies is the reason that I would argue is the most important. And that essentially is the fact that a lot of people started to ask a very fundamental question, which was, what happens if I go quickly? You see, people started to realize that if they go quickly, essentially what that would mean is that they wouldn't have an opportunity to utilize the benefits that are held within their long-term care benefits pool. And of course, the idea of all of that money that they paid into the policy over an extended period of time going into the pockets of the insurance companies, that left a lot of people feeling a little unsettled. And so as a result of that trend that we saw within the marketplace, the insurance companies responded. And the way that they responded was by taking a step back and essentially fundamentally reconfiguring the way in which they construct products. And so today, when we do long-term care planning, we now use what are known as the linked and the hybrid policies. And these policies are phenomenal. They're very popular and for good reason. What's really going on with the linked and the hybrid policies is pretty simple. You start with a life insurance policy, and typically it's whole life insurance, and you basically use that as the chassis, and then you add a long-term care rider on top of the chassis. And the way that whole life insurance policies are constructed, it's really very interesting. You have two components. You have the death benefit component and you have the cash value component. Both of those components are designed to equal one another when the insured individual is 100 years old. So what that means is that for the vast majority of your life, the death benefit is the bigger number and the cash value is the smaller number. Over time, both numbers grow. The cash value actually grows a little faster than the death benefit because eventually it has to catch up to it. But at the end of the day, the long-term care rider, what it does is really, really powerful. And on a side note, a rider, that's an industry term that we use to describe the way in which a policy can be customized. So by adding a long-term care rider, all you're doing is you're taking a life insurance policy and you're customizing it. So the long-term care rider, what it does is really cool. It basically gives people the ability to accelerate the death benefit of their policy for the purposes of long-term care. so you can use your death benefit when you're still alive and when you have a need for care. And this has been a game changer because when you look at those two numbers, the cash value and the death benefit, for the vast majority of your life, the death benefit is the bigger number, but it's not bigger by just a little bit, it's bigger by a lot. So if you give people the ability to use the bigger number when they're still alive and have a need for care, for a lot of people in our society, that can be a game changer. And so that's what makes the long-term care riders so powerful and so exciting for a lot of people that we work with. Now, there is a note about cash value. You know, you can always take cash value out. As soon as your cash value is there, you can take it, you can borrow it, and there are no restrictions on how you can use the money. But when you give people the bigger number to work with for long-term care planning, it can make all the difference in the world. There's a concept that I'd like to touch on. It's called the use it, or use it concept. I will tell you, I love this concept. All of my clients love this concept. The reason people like it so much is because it gives people tremendous peace of mind. Allow me to explain. The use it, or use it concept essentially explains to people how a properly constructed life insurance policy can be utilized within any one of three scenarios. The first scenario is when the insured individual experiences a premature death. We use the word premature because we are assuming that the insured individual has financial goals and objectives that have not yet been completed. So that's why we say premature death. If that should happen, the death benefit of the policy would be there to accomplish all of your financial goals and objectives, and the family will be okay. In the second scenario, the insured individual is blessed with longevity, but they're unhealthy. If that should happen, they would then be in a position to use the long-term care coverage within the policy for the purposes of helping to pay for their long-term care needs. And then in the third scenario, the insured individual is blessed with longevity and they are healthy, which is ideal. And if that should happen, they would then be in a position to use the cash value within the policy for the purposes of supplementing their retirement. So it truly is a use it, or use it. And this provides people tremendous peace of mind because we don't have a crystal ball. We don't know precisely what the future has in store for us. So at the end of the day, you never have to worry about losing all of the money that you pay into the policy over an extended period of time. Special considerations. So we have several. Policy pricing. People always want to know, what does it cost? Well, there are a lot of variables that go into pricing for these policies. The three most important variables are your gender, your health, and your age. Your gender is what it is. Your health is always the wild card. You know, one day you're perfectly healthy, the next day you're diagnosed with something that you didn't even know you had. That happens every day. So that's the wild card. But the age variable, that's the predictable variable. And as I can tell you, the sooner you get started with your plan, the more affordable the rates will be. So starting sooner does have its benefits. As far as underwriting goes, it's very important to be aware of the fact that there is underwriting for the life insurance portion of the policy, and then there's separate underwriting for the long-term care portion. So it's very important to be aware of that. Lastly, we have late stage planners. And I will tell you, when I have meetings with people who would be classified as late stage planners, a lot of times they come to me and they say, Chris, you know, I don't even know if I should be talking to you about this. I don't know. I'm so late to the party. You know, is it even cost feasible for me to obtain coverage? You know, because it would be expensive according to conventional wisdom. But the answer to that question is yes. It does still it is still worth it to explore options, because we actually have one option that a lot of people who are late stage planners find to be viable. And that's a solution where you can make a single premium payment. It's a situation where you make a payment on the front end, and then that's it, you're done. You never have to worry about any future premium payments. And so therefore it doesn't represent an ongoing financial obligation. And that tends to work for a lot of seniors who are at that stage in life. Lastly, we're going to be talking about the process of going on claim. A lot of people want to know, what does that look like? Well, there is this thing called ADLs, activities of daily living, and there are 6. And you can see right up there that we have transferring, bathing, dressing, eating, using the restroom, and then incontinence. And the way it works is if an individual is unable to do 2 out of 6 of the activities of daily living, that individual would qualify to go on claim. And there is one exception, and that is the cognitive impairment exception. If an individual should be diagnosed with either Alzheimer's or dementia, that individual would also qualify to go on claim. What I tell people is, whenever you get to that stage in life where you're no longer able to take care of yourself, this can be kind of scary. It can be thoroughly disconcerting. Nobody likes to think about it. No one likes to talk about it. But at the end of the day, the good news is you don't have to do it alone. If you ever find yourself in that sort of situation, we're here to help. And I will tell you, we have some absolutely phenomenal people on our team, which is known as the Senior Journey Alliance. We have people that provide care coordination services as well as transition assistance services. And I will tell you right now, they're phenomenal. And the members of my team who focus on care coordination services, what they're really doing is so valuable. They're basically helping people ascertain how to optimize the benefits that they have through their plan. That's really going to help them as they navigate those final stages of life. So with that, I'm going to leave you. I'm going to pass it on to my colleague, Sherry Tucker. Thank you.